Hey everyone, and welcome back to the Financial Flux with your host, Tobi Ogedegbe. Today, we're diving into a topic that's been making waves across the economy: tariffs. Specifically, we're going to break down how these trade policies are impacting multifamily real estate operators, the good, the bad, and what you need to consider to stay ahead. Let's start with the challenges, because tariffs certainly bring their share of headwinds. The most immediate impact for multifamily operators is a direct hit to your bottom line through increased costs. We're talking about everything from routine repairs to major renovations. Materials like steel, aluminum, lumber, appliances, and even light fixtures are getting pricier due to these import taxes. For instance, tariffs on steel and aluminum have doubled to a punishing 50%. But it's not just materials. Labor costs are also volatile due to worker shortages and rising wages. And let's not forget the surging insurance premiums, up nearly 28% last year, with more increases expected. These rising costs are compounded by supply chain disruptions. It's becoming harder to source key replacement parts, leading to extended repair timelines and, unfortunately, lost rental income from vacant units. And while you might think, I'll just raise rents, it's not always that simple. Local market conditions, tenant affordability, and especially rent control laws can limit your ability to fully pass on these compounding expenses. Now, it's not all doom and gloom. The multifamily sector has shown remarkable resilience. Despite the economic uncertainty, demand for apartments remains strong. Why? A persistent housing shortage, coupled with the mortgage rate lock-in effect, where homeownership is now 69% more expensive than renting on average, is funneling more people into the rental market. This robust demand helps stabilize cap rates and absorption. Another unexpected benefit is the slowdown in new construction. Tariffs and high building costs are causing developers to pause new projects, with multifamily construction starts down significantly. While this exacerbates the housing shortage, it also means less competition for your existing properties, potentially driving up their value and rents in the long term. There's also a long-term potential for onshoring, where tariffs could encourage more domestic production of construction materials, which might stabilize future costs. So, what does this mean for you as an operator? Adaptability is key. First, budget with more cushion. Increase your reserve funds to cover unexpected repairs or longer renovation timelines. Second, look for operational efficiencies. Consider energy efficiency upgrades. While they might have higher upfront costs due to tariffs, they can reduce long-term operating expenses and appeal to tenants. Third, manage your supply chain strategically. Stock up on frequently failing items and explore diversifying your sourcing to domestic suppliers or countries less affected by tariffs. Finally, implement strong risk management practices, especially for insurance, and stay educated on market trends and policy changes. Tariffs are undoubtedly adding layers of complexity to multifamily operations. They squeeze profitability through rising costs and supply chain disruptions. But the underlying strength of the rental market, driven by housing affordability challenges, offers a significant buffer. By being strategic, focusing on efficiency, and staying informed, multifamily operators can navigate these turbulent waters and even find new opportunities. Thanks for watching. If you found this helpful, please like, share, and subscribe for more insights into the world of real estate. See you next time.